All right, let's be real about money. Have you ever looked at a large, beautiful apartment building or commercial property and thought, I could never afford that? Well, if you're thinking that way, then you're the one I'm speaking to today. Because what if I told you that the best real estate investors aren't necessarily investing their own money? They're using other people's money, or OPM. It's not some sinister scheme. It's strategic leverage. With stocks, you typically need to provide 100% of the cash yourself. But real estate is a different creature. It's the only big asset class where you can use strategic financial engineering, i.e., other people's money, to build your portfolio, manage your risk, and supercharge your returns. And that's what we're going to break down step by step in this video. So what is OPM, actually? At its core, it's the secret to scaling your portfolio. By utilizing other people's money, you're able to execute multiple deals at once, accelerating your growth in a way that would otherwise be unfeasible on your own income. This is how single investors end up with massive, commercial-sized properties like multifamily syndications. Now, there are a lot of people talking about OPM as a way to reduce your own risk, and that is correct, but with a gigantic, vital exception. The risk does not magically cease to exist. When you use OPM, you are not eliminating risk. You are diffusing it structurally. You're taking your own personal capital risk, the risk of losing your own money, and you're translating it into a risk that is specific to the property, now shared with your lenders and your equity partners. So you isolate your own liquidity, which enables you to go out and chase the next deal and the next. In order to understand how this is accomplished, you must have some knowledge of the capital stack. Think of it as cake, where each layer is a different financial instrument. Another way of describing the legal agreement your money partners have with you. At the bottom, you have your debt. These are loans. The lenders here are in a senior, secured position. What that is saying is that when things go bad, they get paid first. They're in the safest position. Then, on top of that, you have your equity, your ownership partners, so to speak. They receive the remaining profits once all of the debt is serviced. But they also get to take the hit first if there are any losses. It's a riskier venture, but potentially for a much greater reward. Okay, now let's get to the good stuff, the numbers. This is where the OPM magic comes home shining bright, and it all revolves around one simple number, your cash-on-cash return. This simply takes the yearly cash flow you get and divides that by how much of your own cash you really put into the deal. Leverage then applies the small number, your cash investment, and cuts it exponentially. Let's run through a fast example. Let's assume we have a $6 million building that has $400,000 of net operating income. If you bought it all in cash, your cash-on-cash return is about 6.7%. Not terrible. But what if you used OPM? Let's say you borrow $4 million and you only put up $2 million of your own money. You pay your $200,000 a year debt service, and you still have $200,000 of cash flow remaining. Now, take that number and divide it by your much reduced $2 million investment. Your cash-on-cash return just went up to 10%. That's 49% better at being productive in your returns, purely because of leverage alone. That's OPM working. So where do you actually get that OPM? Let's start with the lowest cost option, traditional banks, mortgages, and bank loans. This is your cheapest capital, but you pay that cheap price with a lot of red tape, stringent qualifications, plenty of documentation, and drawn-out approval times. Another ancient standby is tapping the equity you already have. If you own a home, you can obtain a home equity loan or a HELOC. Yes, I know what you're thinking. That's my home, but technically, the bank is lending you fresh money secured by your property. So in your new real estate deal, that money is technically OPM. It's not from your paycheck. It's from a lending institution. And what if you need money faster or for a transaction no bank will touch? That is where private and hard money come in. Private money is money from other people you know, family and friends, high net worth individuals, even self-directed retirement accounts. It's much more flexible. Then you have hard money loans. These are your last resort loans. They've got high fees and interest rates because they're all about convenience and adaptability. A hard money lender isn't so much concerned with your credit report. They're concerned with the value of the property and how you intend to flip it. They're perfect for short-term, time-sensitive projects like a fix and flip. The trade-off is simple. Inexpensive money from the bank is sluggish. Expensive hard money is fast. You pick your tool based on the transaction. Let us do this. One investor bought a house for $50,000 and needed $90,000 worth of repairs. They borrowed $130,000 using a hard money loan. They paid close to $10,000 in interest in 7 months. Ouch! But they sold the house and got an $80,000 net profit. The moral of the story? The cost of the capital was entirely paid for by the speed and by the upside. That $80,000 profit would not have been there at all if they had been just hanging around waiting for a traditional bank loan. Occasionally, for quick turns, you need to have that high-priced, high-speed capital. You can even cut out the middleman altogether with seller financing. That's exactly what it is. The seller of the house acts as the bank. You pay them directly. It's a godsend for investors who don't quite meet the requirements of a regular loan. There's another clever strategy called Subject to. You take title to the property, but don't disturb the original mortgage of the seller. You just start making their old mortgage payments for them, and then you can give them a second check for their equity. It's a powerful way of getting a chunk of property for very little money down. When you're doing very large commercial deals, you find more advanced tools like mezzanine financing. It's a hybrid in that it's debt, but it acts very much like equity. In the capital stack, it is subordinated to senior debt, but senior to all of the pure equity. Its key feature is an equity conversion clause. If the developer defaults, the mezzanine lender can convert the loan to an equity stake in a snap of a finger. This gives them the option to swoop in, take control of the project, and salvage their investment without a long, ugly foreclosure. So with upper management OPM, you're not just risking the property, you're risking your management control. You don't have to do it yourself. In smaller deals, partnerships and joint ventures are an excellent vehicle for resource sharing. The classic setup is this. One partner provides the operating know-how, the operator and deal finder. The other partners provide the capital. This way, the operator can get a deal done without having to fund it 100% personally, using money and know-how. To really play big league, you need to understand syndication. That's how a general partner or sponsor is raising money from dozens or even hundreds of passive investors, so-called limited partners, to buy gigantic assets such as apartment buildings. Online platforms have also made real estate crowdfunding, which has made this whole process democratic, enabling small investors to get a piece of these giant deals. This is not a handshake deal. This is a proper legal structure with working documents that establish everybody's role and the way profits are allocated. It's a beautiful exchange. The LPs get access to deals and expertise they would not have otherwise, and the GPs get the capital and build their track record. And now a huge legal notice. The instant you combine money from more than one individual in a syndication, your investment typically becomes a security in the eyes of the SEC, not an option. You are now subject to federal securities law. What this adds up to is serious legal papers, a private placement memorandum, or PPM, a behemoth document detailing all the risks of the transaction, an operating agreement that governs the partnership, and a subscription agreement signed by each investor to commit his or her capital. There is no negotiation. To avoid a nutty, costly public registration, syndicators use exemptions under so-called SEC Regulation D. The two big ones are Rule 506B and Rule 506C. 506B is the old private placement. You can't market the deal publicly. You can take money from any number of accredited investors and up to 35 non-accredited investors. The upside is lower admin load. 506C is the new method. You can market and herald your deal freely. Shout it from the rooftops. But at what expense? Every single investor must be accredited, and you must make reasonable efforts to verify it, which is to say, you need to collect and inspect their tax returns, W-2s, and bank statements. It gives you reach, but it is a paperwork hassle and a humongous data privacy concern. So you can see the trade-off graphically. 506B, low admin burden, but very limited marketing reach. 506C lets you have that massive marketing reach, but your verification requirement and admin burden go through the roof. You, as a business operator, have to weigh the benefit of being able to reach more people against the cost and pain of verifying all of them. So how on earth do you get people to give you their money? With a killer pitch deck. This isn't PowerPoint. This is your lead capital raising instrument. It has to tell an engaging story with lovely graphics, and most importantly, it has to be straight up truthful with realistic, well-researched projections. Transparency is how you build trust. Let's walk through what is in a winning deck. You start with an executive summary that engages them. What is the return? What is the market? What is the competitive advantage? Next, you have to sell yourself in the sponsor team section. Let's be honest. Individuals invest in individuals ahead of investing in deals. You must show them your track record of success. This is your credit rating. Then you transition into the property and market analysis. Show them you know the property and the neighborhood backwards and forwards. The financial analysis is the substance. We'll tackle that one next. And you always leave them with a clear call to action. Tell them exactly what to do next in order to get on board the deal. Financials are where you gain or lose trust. You require 3 important things. First, the T12, or trailing 12 months. This is the financial report card of the property's history. It brings your future aspirations to earth by basing them in today's facts. Second, the pro forma. This is your projection of future expenses and revenues based on what you plan to do and assumptions about the market. And third, and so important, 3-scenario modeling. You draw a likely scenario, an optimistic scenario, and a pessimistic scenario. Stress testing your deal like this shows investors that you've thought about the things that could go wrong and that you have a plan. It makes great credibility. And we're back to our favorite metric, cash-on-cash return. This is the one statistic OPM providers desire the most. It informs them how well their equity is doing. It's simply annual pre-tax cash flow divided by total cash equity invested. We saw how leverage multiplies this number mathematically. But don't lose sight of the risk. That debt service raises your break-even point. That's why that negative case in your model is so crucial. You must show the deal can survive bad times, all that leverage notwithstanding. So, to summarize the key docs in brief, your pro forma shows the future potential. The T12 sets up the current reality. The COC return shows the leverage power. And your scenario analysis builds credibility by showing that you've managed the downside. So let's make it happen all. With OPM, it's not merely borrowing, it's a whole philosophy of constructing your real estate enterprise on a grand scale. It calls you to be a master in 3 dimensions. The numbers game of how to get maximum returns, the structural acumen of where to find the right capital, and the painstaking legal compliance to escape trouble. Your capital choice decides your entire playbook of operations. And don't forget, the last secret to consistently bringing in OPM is not the slick pitch deck. It's your written track record and your unbridled transparency. OPM is the mod for giant scale, but your integrity and your proven performance are the fuel that drive it. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.